Most traders think that by just tracking price action in isolation, you can become a consistently profitable trader. The truth is that price action is only really half the story. The true power in trading is understanding price action in combination with higher time frame candle closures and understanding the relationship between those higher time frame candles. So I'm going to show you in the next 10 minutes exactly how to trade and think about trading monthly candle ranges. And you can do this in very little time once you get used to it. So we're looking at the 12-hour time frame on GBP CAD. I'm just going to overlay the monthly candle onto our charts. So we can see we had a bearish monthly candle right here. It traded below this low and then eventually targeted the high. We then had bullish candle, and now price action's retracing. So how do we actually make sense of this? So I'm just going to take this candle right here in the middle, which was a bullish candle. You can see price initially traded lower and then traded higher and closed. Once we get a close of this candle, we can start to understand what has price just done. So first and foremost, we can see that price has liquidated or broken out above two key areas of liquidity, external range liquidity. So initially, price broke out above the previous monthly high and eventually targeted the high here at the top of the market range. What then happened is that price saw a shift and this monthly candle closed. So we can see price closed at this point here between June and July and entering the new month of July to August. At this exact point, we have a close below the previous candle's high. And essentially what this means is that price broke out and manipulated above this high, but closed inside this candle's range. So we can then take counter trend trades. Now let's take a look at price action. So we have this acceleration into these highs, leaving internal range liquidity. So we can take a look right here at the internal range of this price leg, and we see we have a fair value gap right here, which price trades into. I'm going to mark that in green so that we can see that it is bullish. What then happens is that price retraces into the fair value gap. We get a new push higher, demand stepping into the market, which does not sustain. We then get a shift, a true market structure shift, and a close below this fair value gap, which then is inversed. We also have the formation of a new 12-hour order block. So the last buy candle before this sell-off. So we have new bearish internal range liquidity. Price action in isolation is interesting, but not that interesting. However, the fact that we are manipulating above the previous candle's high with a monthly candle close, and we've raided this market high and the liquidity that sits at this high, this is a very meaningful shift that we can now trade. So we can set a short order on the order block, covering the manipulation, and target the lows at the new external range liquidity that is formed at the base of these monthly lows. That plays out for a 4.88R trade. Just by understanding price action at this high, where price is liquidating, and the new external range liquidity that price creates in the formation of these monthly candles, we can take very high probability swing trades. Now let's just cover a tiny bit of theory just to get into what is a monthly candle range. So a range of price action between monthly open and monthly close. That is essentially a monthly candles range. So we have this lower time frame price action. This is what most traders are just looking at and plotting their trades in conjunction with. But what this is essentially doing is it is creating higher time frame candles. So most traders only look at price action. They have no idea where price sits in the context of higher time frame candles. Why does this matter? Lower time frame price action is simply a higher time frame candle being printed. So if we know this, we can anticipate based on previous candle closures what we think is going to happen in the next candle to place high probability trades. Let's look at another example. So price then shifts. we actually get the sell-off that we're anticipating. We trade back into this low, we get a second trade opportunity. Price then eventually makes its way down to the lows that we were targeting. At this point here, we can see we have the close of a new bearish monthly candle. And what price does is liquidate again to pockets of external range liquidity. So we have this area here and this monthly low. Price action then gives us another opportunity to get involved. So price retraces into the internal range liquidity in this price leg, tries to trade lower, we get a close below, price comes in, we see a shift, a manipulation above the high. It doesn't sustain, but then bullish momentum steps in again, and we get a true market structure shift at these levels. And again, we are liquidating key areas of external range liquidity. So we get the formation of a new bullish 12-hour order block. Price then trades in to the order block and heads very aggressively back towards the external range liquidity at these highs. So we can again use this order block as our internal range liquidity. We have a liquidation of these key levels, and we can then target the highs, the intermediate highs that sit in this retracement. Right there, you have a 3.36 hour trade. Or if you want to hold to the actual external range liquidity that sits at the high of this candle, you've got a 4.64 hour trade. So that is understanding higher time frame candle closures and the relationship with lower time frame trade execution. Let's look at another example on NZD CHF. So let's do the same thing. Let's look at monthly candle closures and then lower time frame price action. So we see the close of this bearish monthly candle between the high in July and the low in July. And this candle closes below the previous candle's low. So you can see this is where price actually closed right here. And it's respecting, or it's closing below the previous candle's low. We're not seeing any signs of reversal whereby price trades in and then respects and trades higher. We're simply seeing lower price action. So as soon as this candle closes, we can anticipate continuations to target at least the low of this candle range. And we can wait to see what happens from a price action perspective to take us to that low. So a new candle opens, we see some consolidation and then a shift, a market structure shift bullish. So we're anticipating lower prices. So we simply wait. Price trades higher, trades into this internal range liquidity, pushes higher again. We get a new order block. Price then trades into the order block, disrespects, comes into the newly formed order block, and then sells off. And we get a true market structure shift. And let me show you how this actually plays out. So we have order block right here, 12-hour order block. We have a fair value gap. Price trades in, trades up, trades down, creates another 12-hour order block right here. So we're expecting price to sustain and go higher from a price action perspective. But it doesn't. It just trades through and creates this new 12-hour order block. The last buy to sell candle. Price trades into this imbalance and then trades out, exposing this low, our target for price. Now, I'm going to let you into a secret. You can then essentially overlay intermediate time frame candles. So right here, I have the 2-week candle. So we have the 1 month candle and the 2-week candle. We know that the monthly candle closed bearish. So if I just zoom out, you can then see, if I take away the monthly candle, the 2 weekly candle. And what is happening? This bullish candle has just closed. It has raided the price or the external range liquidity above the high of its previous 2 weeks candle right here. We then get a structure shift, as I mentioned, the opening of a new 2-week candle. So we have a very high probability trade. and we anticipate that price is going to sell off to not only close lower from a monthly perspective, but at least target the external range liquidity that has built below these lows. So we can then map the internal range liquidity in the price leg, and we see we have a fair value gap, a bearish fair value gap. So we can take a trade from the bearish fair value gap. We can cover the liquidation of the highs in this price leg and then target at least the lows. We have nearly a 2R trade. And then if you want to reach for higher, for more sustained targets, you can do so. So you get a 2.5R, a 3R, and eventually price goes, even in this price leg, to a 3.5R. And then price does retrace and eventually trades even lower. So you get much, much bigger swing position targets if you want to hold beyond that initial surge in price action. So we want to wait for, how are we going to apply this? We want to wait for monthly candle closes. We want to also track intermediate candles. So we're tracking weekly and 2 weekly candle closures, and we're building a story of price on the monthly time frame in conjunction with the smaller time frames that make up the monthly candle. We're then using lower time frame price action, 12-hour price action, 1-day price action, to time trades in conjunction with higher time frame candles. So this is my model. I track and analyze 32 forex pairs, including all forex markets, gold, silver, and Bitcoin. I'm tracking 12-hour price action in conjunction with monthly, 2 weekly, and weekly closes, and I simply execute when it makes sense to do so. Once you get good at this, you can do this in under 10 minutes per day, and you can become a consistent swing trader. If you want to follow more of my videos and understand exactly how I do this and think about trading every single day, subscribe to my channel, and I'll see you on the next one.